Everyone talks about how the market has averaged 8%, 10%, 12%, whatever, some high percentage. If you're 20 years out from retirement, or 10, or 5, or worse, in retirement now, those long-term historical figures can be incredibly misleading. And relying upon them for your financial planning will lead to financial devastation for some. I'll walk you through all the numbers so that you're as prepared as possible. Coming up. Welcome back. If this is your first time here, my name is Steven Spicer, and it's my goal to help you invest smarter. In this video, I'm going to guide you through what you could expect from the market historically over those various time horizons so that you're better prepared to achieve your financial goals. And then in future videos, we'll continue to examine these investment realities and ultimately explore better solutions. If you're serious about finding the best solutions to provide you with the most stress-free financial future possible, don't forget to subscribe and hit that notification bell. When we were younger, my sisters and I received some money from our grandfather. Our plan was simple. We wouldn't touch it until the time came, but we wanted to buy our first house. That meant that the money would be growing for years in the background, managed by an Edward Jones representative, in fact. My sister closest to me got married and purchased a house near the tail end of the 01 through 07 stock market bull run. I had studied the stock market. I knew the buy and hold mantra. I was disciplined. As the market started to turn over near the end of 2007 and all through 2008, I was like a stone, immovable, without emotion. While the world around me was freaking out, this was my chance to prove my ability to disconnect from all that chaos. I succeeded. Beyond all expectations, I proved I had what it takes. I could suck it up and stay the course with the best of them, even in the face of a roughly 50% crash. The market started its rapid recovery in March of 2009. I had remained rational the entire time. I hadn't panicked in the slightest. Needless to say, in that moment, I was proud. I felt like this was my first real test, and I passed. In the summer of that same year, I got married to a very special girl. We lived in my tiny 300 square foot studio apartment for our first year of marriage, relishing all the money that we were saving with our crazy cheap $250 per month rent. In June 2010, it was time to upgrade. I was starting to make decent money as a financial advisor, so we felt comfortable dipping into that investment account to help with our down payment. It was then, and after a conversation with that sister who purchased her house in 07, that I realized how much less I was dealing with than she had. When she had purchased her home in 07, her investment account was more than 65% larger than mine was when I needed it in 2010. I didn't complain, nor was I upset at all. That's not the point here. I was, and am to this day, very appreciative for my grandfather's gift and hard work. Instead, this was the beginning of my quest to find better ways to invest, to challenge the traditional financial paradigms. It was the seed of my desire to critically consider any financial advice I heard, even if it was common practice, advised and accepted by academics and experts alike. But for my case in point here, it was a slap in the face as to how much the timing of exactly when you need your money can impact your bottom line. In truth, this reality was not a huge deal for me. It didn't set me back in any way. This was gifted money after all, money I wouldn't have otherwise had, so in my mind at least, whatever the balance, I was ahead. But for those preparing for retirement, after decades of hard work and dedicated savings, that difference could be devastating. Before this personal experience, I never really noticed this happening to others. But after that, for several years, I saw it everywhere. It was like the Bader-Meinhof phenomenon, the so-called frequency illusion, whereupon discovering some obscure bit of information, you start to see it everywhere. It's like purchasing a red car and then you start to see a red car everywhere. It's the same type of thing. I had client after client come to me needing to delay their retirement plans because of the 2008 market decline. Some even had to come out of retirement and pick up a part-time job as a Walmart greeter or something like that. I'd see similar stories on the news and in the paper. It's difficult to fathom the tens of millions that were affected in that same way. Fortunately, the frequency of these occurrences declined over the following years until in 2013, it wasn't really talked about much at all anymore. People who had been planning to retire in 2014, 15, 16, and so on were relatively unaffected by that massive crash, or at least they had plenty of time to adjust and prepare for a different reality. They weren't slapped in the face by the same flip of a coin, sucks to be you, harsh reality as those with the exact same goals and circumstances from just a few years earlier. The downfall of that earlier group was simply the fact that they were just a few years older, just a few years ahead. Wrong place, wrong time. Timing matters. Your planning and expectations for market performance should not just be a flat X%, 12, 10, 8, or even 6. It's not that simple. The amount of time you have before wanting or needing the money to achieve your goal will have a huge impact on what you should, historically, expect. It seems like most advisors and pundits, and consequently people in general, just take the 30-year average and run with it. It definitely does make this all look way more compelling on the surface. Even using real returns, explained in this video, a 1% management fee and a 0.4% fund fee. Those are both relatively low assumptions based on the industry averages. See these videos respectively. With those assumptions, the S&P 500 has averaged 9.6% per year across all 30-year periods since 1926. That's fantastic, right? It is. Of course, we're talking about an average here. We often are. So flip a coin. You might end up above that number. You might end up below. But even then, the historical range from best 30-year period, 12.2% per year, to worst 30-year period, 7.0% per year, is not very wide. Conclusion, if you have a 30-year time horizon, so if you're in your 30s or younger, good for you for taking this so seriously, by the way, and you entirely disregard our debunking of the myth that the market will always continue to go up, coming soon on this channel, so subscribe so that you don't miss it, then sure. Assuming a conservative 9% average annualized return and preparing for the worst case possibility of 7% would be perfectly reasonable in the beginning of your planning years. But as you approach that retirement or whatever other goal of yours, wouldn't it make more sense to consider a more relevant time frame? Do the 30-year numbers really apply to you anymore? When you're 20 years out from that goal, your worst case, historically based possibility is no longer 7%. Far from it, in fact. The lowest average annual return the market has ever realized over any 20-year period since 1926 was a bleak 1.7%. That's the difference between $100,000 growing to a mere $140,000 after 20 years instead of the $390,000 your forecasted worst case scenario would have been under that previous 7% assumption. Over any 15-year period, it was an average loss of 0.8% per year. 10-year period, negative 2.8% per year. But what if you're just 5 years away from your target age? This is where so many receive terrible advice. Because advisors are talking to their clients about making their money work for them during retirement, about allowing it to grow in the market so that it can support them during the next 20 or 30 years while they're out of work, they're still focused on that 30-year average return figure. This is what I discovered with all of those clients who had been preparing for retirement within a few years of the Great Recession. They had to delay their plans due to what their previous advisors had called unforeseeable events, the ominous black swan. Except it wasn't unforeseeable. In fact, historically speaking, the 5-year, 03 to 08, average annual loss due to that crash, negative 3.8%, was a fraction of what it's been in the past. For instance, the worst 5-year average annual return for the market was a 13.7% loss. That's per year for 5 years. Sure, that kind of loss is not common, nor should it be expected, but it was far from unforeseeable. In fact, 15 of the 89 5-year periods since 1926 have yielded negative average annual returns. That's 16.9% of the time. For context, you have a 16.7% chance of rolling a 1 on a 6-sided die. But this isn't a die you'd be rolling once every 5 years. You'd be rolling it every single year. Think about that for a moment. If that's how it was, would you treat your investments differently? If the roll of a single die at the end of every year is what determined whether your average annual return over the previous 5 years was negative, anywhere between negative 13.7% and negative 0.9%, historically speaking, of course, would you play the same when you're 60 as when you're 20? I get it. It may feel as though you don't have any other option. You do. That this is the only way to really build wealth. It's not. That these are pretty good odds anyway. That you just have to cross your fingers and hope those negative spells don't hit right before you are about to start your retirement. All of those thoughts are rooted in financial industry myth. We'll tear them down for you here soon enough. All you need to do right now to ensure that you get that valuable information the moment it's available is subscribe and make sure you have your notifications on. One final thought down this train of ever shorter time horizons. When you're in retirement, it can be even worse. If the market is down 50%, what are you supposed to do? For every 1 year that you maintain your current standard of living, you'll be shaving off 2 years from your retirement projections, because you'll need to sell twice as many shares of stock since they're all worth half as much. Historically speaking, there will be at least a couple of major crashes during your retirement. In a couple of weeks, we'll explore exactly what this looks like, how planning for periods of withdrawals is even more complicated than these static figures that we've been considering thus far. And next week, we're exploring contribution periods and the unique challenge there. Here's a teaser for you. That 5-year worst case scenario during times of regular contributions actually drops to negative 24% per year. It's insane, right? I'll explain it all next time. But back to the point here. Not only is that fixed average annual return assumption not good enough to best prepare you and your assets to achieve your goals in retirement, relying upon it could be devastating. Understanding the time-based potential of your market investments becomes essential for creating a plan in which you can be confident. Just relying on the experts, oh, don't worry, you should expect an average 8% or whatever over the long haul, is not particularly helpful for you, especially when you're in retirement or really close. It does, however, make their money management job much easier when their advice is just don't touch it. Don't worry, we're going to help you discover some better strategies. If you appreciate these detailed videos, helping you have a better handle on your financial future, what to expect and how to prepare, then I hope you'll let us know by hitting that like button wherever you can. It means a lot, more than it should. And if you'd like more value from us, you should definitely check out our new community. I'll link out to it in the description and in the cards there on the side. I hope to see you in there. Regardless, I wish you all the best.